Hello, welcome to this episode of The Financial Incline. I'm your host, John Bovard. Today, I'm thrilled to share with you a recent webinar that I hosted with Ely Friedman. Ely is the Director of Mergers and Acquisitions at Von Lehman CPAs. During our conversation, we discussed the different methods you can use to value your business, what to look for in a company's financial statements to help you determine the value, what are some common valuation multiples that we see in the market today, and lastly, we discussed what are ways to increase the value of your company. So if you are a business owner and you are struggling to determine how you can go about valuing your business, make sure you check out this episode with Ely Friedman. Appreciate everyone joining us today. For any of you that I don't know, my name is John Bovard. I'm a CFP, IRS enrolled agent. I'm the owner at Incline Wealth Advisors, where we work with business owners to help them build their desired lifestyle. And whether that be helping them with their investments, financial planning, if they're looking to buy or sell a business. And today I'm thrilled to be joined by Ely Friedman. So Ely, I've known for a while now. I've done a couple workouts with Ely. So if any of you are looking to get in shape and find a good group of guys to work out with, definitely hit up Ely. And if you like getting up early and working out outside, Eli's the guy to go to there. But no, Ely does a great job working day in and day out with business owners in the lower middle market, helping them to drive value of their business, helping them to link them up with buyers, helping them acquire businesses. And, ultimately he himself and his team that he's got at Von Lehman does a great job working with their clients. So one of the things that often comes up, whether I'm dealing with clients or even if I'm valuing stocks or even private investment offerings, that I see is trying to come up with a valuation for those, trying to come up with a proper business valuation. So that's why I'm thrilled to have Ely joining us today. And I'll hand things over to Ely if he wants to do a quick introduction before we jump in and get started.
Yeah, thanks, John. I really appreciate it. So again, for those who don't already know me, Ely Friedman, Director of Von Lehman's M&A practice here. Specific for our M&A practice, we're dealing with the actual sale of a company or the actual purchase of a company. We have a great valuation department that does the academic valuations for trusts and estates and a lot of things that John works on. But in my small little sliver within the market, I'm really focused on generating valuations for my clients to really set expectations and have them have confidence that when we go to sell their business, that they're actually going to get paid at least, if not more, what we're giving them guidance on. And in the instance that we're helping buyers buy, obviously we want to protect and make sure that they're not overpaying for the business. And so within that vein, it's really important to understand that the purpose of my valuations is a little bit different than if you were a true valuation specialist that is serving a valuation for an ESOP because it's a requirement, or if it's for your trust and estate. And the reason behind that is really just the assumptions that come into it and the overall approach. And so for me, in my valuations, we really focus on a multi-factor approach where we're using multiple methodologies to help value a business. And the most common ones that you'll hear about are comparative transactions, which most of you should be very familiar with because you are commonly seeing them in real estate. And it's things like per square foot and comparing this house is similar to my house. And, it just recently sold for whatever amount. So my house should be pretty similar. Although it's not an exact match, there are some publicly traded financial information that is available for business transactions. What you should know is for every one that is available, there are thousands that are not available. And it's just the nature of how confidential and private most of these transactions are. And so as a result, you do unfortunately have to rely on somebody that is just living in this industry each and every day. So folks like myself, folks in the greater M&A ecosystem, we are constantly networking with buyers. We are constantly networking with sellers. We're always hearing how businesses traded. They may not disclose exactly what the purchase price multiple is. They may not share exactly what the business size was in terms of sales or EBITDA, employee count, square feet that the manufacturer had or the distributor had in their facility. But we've been at this long enough where we can triangulate about the size of the business and approximately what that business traded for when it eventually sold to another company or to a private equity institution. And so those comparative transactions, it is a number, but it is very much a relative number. So you're going to look at what is publicly available, and those multiples you can find on very, very expensive software that we subscribe to, which is great. But what I argue is more important for comparative transactions, and something I always like to layer into in my valuations, is I have lots of calls with other friends that are investment bankers in the industry, lots of calls with private equity professionals that have done deals in that particular industry. And I ask him, hey, what are you seeing for businesses trade in a certain size in a certain industry? And they're willing to disclose bits and pieces that I can then pull together to determine what their comparative transactions are. And so if I take those private, non-disclosed pieces as well as the publicly available comparable transactions, I'm able to generate what I feel is pretty confident in terms of the comparable transaction methodology for valuing a business. One of the other ways to value a business is utilizing a discounted cash flow method. And so for those that aren't familiar with the discounted cash flow method, effectively all you're doing is you're projecting your financials out about 5 years into the future, and then you're looking at the present value of those cash flows. Those projections will vary wildly. If you talk to certain business owners, they will say that they're going to double and triple their business, and I think that that's great, wonderful aspirations. But that is no way that I want to provide valuation guidance to anybody. And the reason being is because it's really, really difficult for a buyer to agree that those assumptions are true and valid if they're not substantially reinforced by historical data. So if your historical data is demonstrating that each and every year you're doubling your business, yeah, there might be some merit to projecting out your financials in that great of a light. But in most instances, you're probably going to be looking at something that's a little bit more conservative, something between 10 and maybe 15% growth for a good, strong company. If your company has not been growing at all or has been growing, less than 5% in the past 5 years, it's really, really hard to convince a buyer or anybody who is hopefully coming from an unbiased position to think that your business is going to be all of a sudden growing at a much higher rate. And so when we're making those assumptions, when we're making those projections for our clients, we're really having lots of conversations with them. We also subscribe to a lot of industry data, right? So we can track and monitor, hey, this industry's actually booming right now, and this company being in that industry is going to be riding the coattails and along for the ride, and that's great. And we can increase those growth rates into that valuation with a lot of confidence because we have the industry reports that demonstrate that it's going to be a great time in the market, right? Yep. And there are plenty of other industries that maybe don't perform at such a high and exciting growth rate. There's a lot of people that like to point to, the old newspaper business. Well, if you're in the newspaper printing business, it's maybe not as exciting as it was 15, 20 years ago when people actually used to read newspapers. And the same is true with every other industry, right? There are cyclical natures to them. Some of them are seasonal. And those are all things that you have to take into account when making those projections to then calculate what the present value is of the projections for today's value.
Yep. So well, great. So yeah. So Ely, so you definitely touched on two methods that you can use. So looking at comparable companies, maybe in the same industry, maybe the same size companies, and then the discounted cash flow as well. In addition to those two, are there any others that you would use as a kind of a strategy or a technique?
Yeah, so arguably one of the most sophisticated financial models is called the leverage buyout model. This is one that is used very frequently amongst the private equity community, and it's a returns-driven approach. So all private equity funds, they're going to have a certain internal rate of return that they, for their investors, are trying to meet. And for lower middle market transactions, the ones that I'm usually working on, that internal rate of return is usually somewhere between 18 to 25%. And when you're utilizing that financial model, there's a lot of things that are driving it. Obviously, the financial performance of the business, yes, but so too does the cost of debt, how much debt is going to be on the business, and how much equity or seller financing that the seller is going to be utilizing in the transaction. And so, amongst all of those factors that are driving the internal rate of return, you're really trying to come up with how much is a buyer willing to pay for a business so long as they can still meet that investment threshold. And for a lot of folks, it is a very fluid model in which you can derive the value of a business and manipulate the value of the business by changing some of the underlying principles. So if the underlying principle goes from paying the seller 100% cash to now using a little bit of rollover equity to the business owner, well, now the returns are coming down because the buyer is no longer receiving 100% of the proceeds because they don't own 100% of the business. And so if you don't really understand all of the different drivers within the leverage buyout model, and you don't really understand the approach that the private equity community is utilizing, it's really hard to negotiate the purchase price and the valuation of a business with that subsector of buyer types.
Okay. Well, good. Yeah, that's I know leveraged buyout, as you go up market or larger companies, that may become more and more popular of a strategy to use. How often do you see book value or kind of like an asset value for a business? Does that come up very often for you?
So the types of clients that I'm working, it doesn't.
Yeah.
I have heard and seen that the book value of the assets is a common approach for those that are buying businesses that maybe aren't growing near as much. There might be a rare instance where a business just has a ton of inventory and property, plant, and equipment where that value is honestly more than a purchase price multiple of their earnings, of their EBITDA.
Yep.
And I could see where that could play a part in it. But fortunately for me, the businesses that I'm dealing with, they're generating good cash flow. They're getting paid a healthy purchase price multiple. And the value from those other three methods usually is well above what the book value of the assets are. And I would also caution a lot of people to look at the balance sheet, because if you're working with somebody like John, there might be some benefits to depreciating some of those assets and having some tax shielding mechanisms in place to minimize your tax burden per year.
Yeah. Yeah. You bring up a great point with depreciation. So, Ely, are there certain things that you would look at in a company's financial statements? So whether it be the balance sheet or the income statement, statement of cash flows, what should we be on the lookout in trying to unpack or uncover as we're evaluating companies by looking at their financial statements?
Yeah, it's a great question, John. I would say you have to really use a lot of caution of getting married to one particular type of financial statement. They are all connected, and if you focus too heavily on the income statement, you could be really missing something on the balance sheet or on the cash flow statement. And so it's important to review all of the financial statements in unison, just so that you're getting a full picture of it. But to provide a specific example, perhaps, you can look at the income statement and you can look at a particular line item and you can say, hey, this line item on that income statement has really increased or really decreased relative to historical periods. And you really have to think critically as to why did that increase or why did that decrease? And a classic example that we can point to is things like payroll, wage expense.
Mhm.
So on the income statement within the operating expenses, you have your normal payroll that you're paying all the employees. And if one year it's let's just say it's 200,000, and then the next year it's 240,000. Well, I don't imagine that everybody got a substantial increase in their base salary. I would make a pretty good assumption that they probably hired some low level employee for about 40 grand a year.
Yeah.
And the same is true on a much larger scale. And there's a lot of complexities to that, right? Because you have many industries that are currently having a ton of turnover, often to no fault of their own, but just a function of where we are in the market. There's a lot of people moving from one business to the other, and you have to account for the net effect of that. And what's important to think about is the timing. So within your valuation guidance that we always try to provide, we want the most recent trailing 12 months of financial performance. And what that does, it allows us to account for that constant change that the business is under. And so in the instance that you have a high level employee or multiple employees that are either being added to an organization or are removed from an organization, you can account for those changes by making certain adjustments. And so if, for instance, a company's financials that you're looking at, they have a CFO that was paid $250,000 per year. Well, they fired that accountant or that CFO in June of the year. Well, if you're looking at the trailing 12 months financial performance and he was gone or fired for, 6 months of it, well, you really need to double what his salary was
Right.
to get a true and accurate picture of what that business's earnings were. So that would be an example on the income statement, but you can have examples on, the cash flow statement or balance sheet as well.
Yes. Yeah. And the other items to look at as well that I tend to jump out of me are definitely margins, right? I mean, that's, something that can help to determine value, and that might make the difference of, similar size company making a similar amount of revenue, but one might be, significantly more valuable just based off of those margins. Are there any profit margin numbers, whether that be gross or net, that you typically like to see for a business that makes it more valuable?
Yeah, you're bringing up a really good point, and I think it's important to consider it on a relative basis for the company itself when you're looking at evaluation and how their margin profile has changed. And so if their sales minus their cost of goods sold and their gross profit divided by revenue, that's their gross margin. And if that gross margin is declining, that means their cost of goods sold is going up relative to their sales. And so if there's a business that you're trying to put a value on and that margin continues to decrease, then in your projections you have to take that into consideration. And it does drive a significant change in the valuation is if there's any margin compression or margin expansion. The other type of margin that we often see change, sometimes pretty wildly, is the operating margin or the EBITDA margin. And so outside of the gross margin, it's the operational leverage of the company. And so in the most simplistic of terms, it's for every dollar of sales that the business increases, you don't necessarily have to pay another dollar for all of your back office services, for your IT support, for your HR support, for your accountants, for all of those types of things. And so naturally, as you continue to scale and grow, your margin profile should improve. And that's really, really exciting for investors and for buyers and for your valuation. And it's a double-edged sword though, because if you're hanging on to extra people and your margins get squeezed, your cost of labor is increasing, your sales aren't increasing, it cuts both ways where your margin profile is going to start to really erode. Right. And so you have to keep a close eye on your financials. And we encourage all business owners to every month look at KPIs and make sure they're tracking those types of things to react accordingly.
Yeah, yeah, definitely. And the other thing I've noticed from evaluating businesses as well is depreciation. And you touched on it before when we were talking. How should, an investor, somebody looking at valuing a business, how should they treat depreciation? Because, I get that it's an add back. It can help for SDE on some of the smaller companies. What are some things to watch or look out for around depreciation?
Yeah, depreciation is a tricky one because it's a non-cash expense. You should see it on the cash flow as well as the balance sheet, the decrease in the asset, as well as the income statement as a decrease to your pre-tax income. What I would tell you is it impacts the valuation a little bit less, but it really impacts potentially the overall purchase price, depending on the deal structure. And so what may be important is to take a step back and define the differences between purchase price and enterprise value, versus equity value and things like that. So enterprise value or purchase price is the total value of the business, irrespective of the assets like cash or debt, which is usually retained by the seller. And so if you want to consider the depreciation component, it really comes down to a structure change that the buyer may or may not be desiring. And so in most instances, and something that you and I, John, have talked about, a number of times, is the difference between a cash transaction or an asset transaction versus a stock transaction. Right. And so treated differently from a tax perspective. And so if they are not structured and if the purchase agreement doesn't explicitly say that there's some kind of protective provision for the sellers in a stock transaction that for tax purposes is being treated like an asset transaction, if there's no protections in there, there is an ability for buyers to then take that fully depreciated value of the assets and rewrite them up to a higher amount so that they get to benefit in the future of the depreciation expense, which is a tax shield. Right. But the IRS is going to say, well, hold on a minute, the seller, they already depreciated those assets and they already had that tax shield, and you can't double dip with the IRS. And so the IRS is going to go to the seller and said, hey, you owe me some money because you got all that benefit of a depreciation, when this new buyer is saying that they should get the benefit. And that becomes a complete mess. And depreciation is absolutely something that you want to protect because it's a benefit that you've already received.
Yeah. Yeah. Great point there. And you're exactly right. It's a very nuanced topic, something to keep an eye on, and hard to fully understand, right? I mean, it's something that you'll have to definitely bounce off a couple of people and brainstorm, when it comes to depreciation. So the other question that comes up pretty often in valuations, and you touched on it earlier as well, is multiples. So how do you typically use multiples? And I know that there's several factors, based off of industry, if it's a service-based business, a technology business, a manufacturer, distributor. Multiples range in various different ways. And obviously size of the company, revenues, net incomes, that has an impact on multiples as well. So how are you typically using multiples when valuing businesses?
Yeah, so I touched on the comparative multiples that are publicly available or things that we hear in conversation, but it's actually the underlying characteristics of the business itself that should be driving the multiples that are paid. And so depending on the characteristics of the business, they may be receiving a multiple of revenue or sales, or they may be receiving a multiple of EBITDA or some other earnings metric. Yeah. And the actual multiple itself, it does range dramatically depending on the industry and some other characteristics of the business. But as some examples are, customer concentration. If one of your customers is 30, 40, 50% of your business, that's not going to be as attractive as a very similar business that doesn't have that underlying characteristic or risk of having customer concentration. And so if If we determine that, the business with the customer concentration is, call it 4 times their EBITDA, then a business without that risk should be worth more. And, I would argue pretty substantially more. Maybe it's a half a turn of EBITDA more.
Yep.
And you can go through each and every characteristic of the business to determine whether or not it's on a relative basis more or less risky. And any business that is going to be less risky, it should drive a much higher purchase price multiple.
Okay. And then as the business grows, becomes more established, people toss out numbers. If it's $500,000 in EBITDA, $1 million in EBITDA, or, compare that to a $3 to $5 million EBITDA business, assuming you use larger multiples at that point.
Absolutely right. Multiple expansion is the quickest way to increase your purchase price multiple. Size matters. It is so much easier for any investor or buyer to buy one business that is 100 million than to buy 10 businesses that are 10 million in sales.
Yep.
And so naturally, they're going to be willing to pay more for one business that's of size, because they don't have to find all of the other 9 businesses. They don't have to do due diligence on all of the other 9 businesses.
Yep.
And they don't have to integrate 9 different businesses. And so because of all those different reasons, folks are willing to pay more for those particular businesses. And so what I would say are the biggest breaks in terms of size. The most common is really just the buyer universe. And so when you're opening up a new buyer universe, there's a lot, more and different types of people looking at your transaction. And as a result, they're viewing the valuation of the business slightly different. Mm-hmm. And so the buyer universe, when you get to approximately 2 million of EBITDA, that really begins to change from, call it, high net worth individuals, family offices, local competitors to a certain extent. Those folks are going to be interested in the businesses that are less than 2 million of EBITDA. Okay. Well, once you start getting to about 2 to 10 million of EBITDA, now you're talking about private equity investors that are going to be very, very interested in the opportunity. You're going to be talking about major corporations, public corporations, international corporations that are going to start to give attention to those businesses. And so I would say the break points for most industries is, call it, 2, 5, and 10 million of EBITDA. Okay. And that's where you'll see, call it, 1 to 2 more turns of the purchase price multiple relative to the EBITDA. So if you're a 4 times EBITDA business at 2 million of EBITDA, you might be a 5 or 6 times EBITDA business at 5 million of EBITDA. And if you're at 10 million of EBITDA, you might be looking at high single digits, low double digits.
Yeah. Yep. Yeah. So for business owners, I mean, that is a way that you can exponentially grow your wealth, right? I mean, you're getting some serious leverage if you're able to drive EBITDA, able to increase net income. That's what you can drastically, increase, and can definitely be life-changing. I mean, if you can raise the multiple on your business, make it more valuable. And I know that at Von Lehman, that's, the work that you do, Ely, is helping business owners with that. So what are some techniques or some ways, I know we've kind of asked this before on a previous podcast, but that you've helped business owners to increase the value, whether it be ways to increase EBITDA or ways to potentially increase that multiple?
Yeah, absolutely. So the multiple in particular, that's a little bit easier to change. And a lot of it just comes down to characteristics. So having those conversations with customers to say, hey, listen, we've been doing business together for 5-10 years. You know that you're going to work with me next year. Let's just sign a contract or some kind of an agreement that just says that we're going to continue to work together next year. And you would be surprised at how welcoming that one piece of paper is to the buyers, that just give them a little bit of comfort that there's some type of mutual understanding between you and the customer, that things are doing well and there's visibility into the future of you guys working together. And it's a small change, but it's a good change nonetheless. I would say in terms of making changes to the EBITDA, tracking and managing expenses. You and I have gone back and forth so many times with business owners trying to find, okay, what is personal, what is business and how do we make some adjustments to make it more normal, right? And so you and I will look at, what are those golf expenses that are going through the business? What are the family expenses that are going through the business? Business owners pulling out, $300,000 a year for their personal W-2s, but then they're also spending another $200,000 on vacations and things like that.
Yeah.
And so trying to normalize that EBITDA a little bit, that really can drive a lot of value because honestly, we've got so many small expenses that it's easy to miss some. And so having the time to just sit with you and go through that with the business owner has been really, really valuable.
Yep. Yep. Well, great. So, Ely, to recap, we talked about, some of the techniques around how to value a business. We dove into the financial statements and what to look at there. We also discussed, multiples, and then as kind of a bonus, ways that you can increase those multiples and potentially drive value. So, Ely, I know, for those of you on the call, Eli's very active on LinkedIn. He's active in the local community as well, out and around town at different events. Can't forget the fitness group as well. So F3. But like I said, if you're interested in learning more, make sure you reach out to Ely. You can find him on LinkedIn. We can post his email address as well. But before we wrap, anything else that we'd like to add, around valuation?
Yeah, I think what's really important for folks to understand in terms of the valuation is that it helps drive a decision for the businesses, for the business owners, and that decision is not solely me. And I would just encourage business owners to lean on their financial advisors to have that financial plan to make sure that the value that you're getting, albeit I would argue when we're selling a business, it's the best. But sometimes the best is not good enough for your own personal financial plan and your own spending habits and your own goals and aspirations of being philanthropic in the local community. So you really have to work with a good financial advisor like John to help you understand what those goals are and if you can afford to do them in the event of a sale.
Okay. Well, great. Ely, I appreciate the time. Appreciate everybody joining in today. Like I said, this was recorded, so we'll try to get this up and running as quickly as possible. But again, Ely, thank you for your time.
Absolutely. Thank you, John.